Hi everybody, and welcome to our weekly risk events video for the week beginning Monday, January the 18th, 2016. We'll start by giving a little bit of a recap of what we saw last week. Remember, we continued to see that rout in the commodities market continues to affect the currency market. We saw the market really focused on China and going back and forth between that risk on and risk off sentiment. Commodity currencies really took a beating. Equities markets were pressured. Safe haven currencies were benefiting. We've seen the yen, the Swissy, the euro all tend to benefit when the market goes into this risk off type of a mode. The Canadian dollar has remained seriously pressured because of the decline in the oil market, and at the same time, the US dollar has benefited from that decline in the oil market. So just having that understanding about what's been affecting the markets here as we begin 2016, and this has really been the same theme that we've seen since the beginning of the year. Okay, so anyway, that brings us to our calendar here. Today, US holiday, no major data for US or Europe, so we'll go ahead and skip right into Tuesday. Tuesday, things get interesting, and we'll start things off in the Asian session with the GDP out of China, as well as the industrial production. These figures do have the ability to move the market, especially with such a focus on China right now. What could happen if these numbers do come out negative? We could see it continue to pressure the Aussie. We could see it affect the Asian equities market by pushing the Asian equities market lower, creating or showing that the market is in that risk-off sentiment, which would likely boost the safe haven currencies and put some pressure on the higher yielders. So GDP, the forecast from Bloomberg, as far as the analysts there, is 6.9%. I think Reuters has it at 6.8%. And the previous is at 6.9%. So what we would look for is any major deviation from the expected numbers here. And also remember that since the industrial production is coming out at the same time as the GDP, it could either boost that data, or it could actually have an effect to mute that data if they come out mixed. Okay, so if they both come out positive, we could see the Aussie get a bit of a rally. We could see that risk on tone come into the market by seeing Asian equities rallying. If they both come in negative, that'll likely pressure Asian equities. It'll pressure the Aussie. We'll see flows into the safe havens. UK CPI expected to come in at 0.1%, on par with the previous print at 0.1%. We've seen a lot of pressure on the British pound here lately as expectations for their first rate hike have continually been pushed back now towards the end of 2016, potentially early 2017. So we would look at the risk to the downside on this on any negative print from the CPI. Inflation, a major concern. It's going to continue to be a major concern, especially with what's happening from a global perspective right now and the continued fall in the commodities market. German ZEW economic sentiment expected to come in at 8.2, about half of what we saw the previous print there. Not likely to have a major impact. We could see a short-term effect on the euro, but remember we do have the ECB coming up, and this is not likely to affect the ECB, their decisions or anything like that here moving forward through the week. So likely to have a short-term effect on the euro, especially with a large deviation, but not likely to be sustained. Then we have the GDT price index, very important print for the New Zealand dollar. Dairy price is extremely important to New Zealand, and you can see we had a negative print last time. One of the things that we really focus on when it comes to the RBA, the RBNZ, and their ability to remain on hold are the dairy prices. So that'll be something that we have to pay attention to. We'll also get the New Zealand CPI for the December quarter, expected to have contracted 0.2%. There is some speculation that this could fall a bit more, and if that happens, we would likely continue to see some pressure on the Kiwi. I know Westpac has come out and said that they estimate the CPI has fallen by 0.4%, which would bring annual inflation down to 0.2%, which would be a new low point for the current cycle. And that would likely add to speculation that the RBNZ would indeed need to cut further in 2016. That brings us to Wednesday, where we'll start off with the UK labor market average earnings expected to come in at 2.1% according to Bloomberg. The claimant count change 4.1 thousand, and the unemployment rate expected to come in at 5.2%. So if these numbers do come out on target, we'll likely see an initial reaction by the market here. However, nothing sustained. If there is a deviation, this would likely have a significant move in the pound. And right now, considering the downside pressure, I think the bigger risk to this, if this comes out negative, we've already seen what's happening from a global perspective, putting pressure on inflation. The UK already has an inflation issue now. If jobs start to come down, that could put some significant pressure on the British pound if these numbers come out negative. CAD manufacturing sales, likely not to have very much of an impact, just considering we have the Bank of Canada coming up later in the session. Building permits, not really a big market mover, but the CPI and the core CPI could have a pretty big impact on the U.S. if there is a deviation there. Remember, the main measure, the preferred measure of the Fed is the PCE, the core PCE. However, the Fed also pays attention to CPI and PPI, so a deviation here could see some significant movement in the U.S. dollar as well. CPI for the month expected to come in flat at 0%, and the core CPI month over month expected to come in at 0.2%. Then the main event for Wednesday is going to be the Bank of Canada, the rate statement. This has really changed here because, or the expectations have changed here because of the continued fall in the oil market. So here you can see the overnight rate according to Bloomberg. Analysts are expecting a 25 basis points. So this basically tells you that this is going to be a volatile event no matter what happens. Okay, if we do see a cut, since it's been such a dramatic change, I think a month ago we were at about 17%. As far as the OIS market was pricing in the chance of a cut. It was largely anticipated that the Bank of Canada would remain on hold through 2016. But now that we've seen this decline in the oil market, now analysts are expecting at this point a 25 basis point cut. So if that happens, we'll likely see the CAD fall some more. And if it doesn't happen, that could give a bit of a boost to the Canadian dollar, because the market is beginning to price in this rate cut. And then we'll also get the statement as well as the monetary policy report, and then later on in the day we'll get the press conference. So likely to be a very volatile day for the Canadian dollar. That brings us to Thursday, where we'll get the minimum bid rate from the ECB. No change expected there. And it's probably not likely we're going to see a whole lot of a change in the statement as well. What to look for there will be any additions to what we're seeing from a global market perspective right now, how the ECB views the development with commodities in China, and obviously listen for anything concerning the current stimulus package. It's likely that they'll leave the door open for it, but won't really specify any future plans. At least that's our take on it at this point. Then we'll have the ECB press conference. So for Thursday, expect volatility on the euro, as those will be the main events. Later on, we'll get the Philly Fed manufacturing index out of the U.S. Not really a huge mover. That's a regional manufacturing data point. it could have an initial impact on the US dollar, but likely nothing sustained. Unemployment claims expected to come in 281,000. Saw a bit of a rise in those unemployment claims. Again, that's a weekly number, so it's not something we would look to be or to create a sustained move on the US dollar. But if it does come in well outside of expectations, we could see an initial movement there on the US dollar as it reacts. And that brings us to Friday. French flash manufacturing PMI out of the Eurozone. We'll also get the German flash manufacturing PMI. Both of these would only be expected to create short-term moves in the euro. And if they both come out in line, basically, or I shouldn't say in line, they both come out negative, that could pressure the euro. If they both come out positive, that could see some boost to the euro. But if they come in mixed, likely not going to have a very big effect. UK retail sales expected to come in minus 0.1%, so looking for a contraction there. This could have a short-term impact on the pound for the session if it comes out with a big deviation. Remember, it is Friday, so traders are a little bit more reluctant to get into trades on Friday. We see more profit-taking come into play. So it would likely only be a short-term move. And then we have the core CPI and core retail sales prints out of Canada. Remember, we're going to have to look at the Canadian dollar in the context of what happened with the Bank of Canada earlier in the week, as well as what's going on with the oil market. But these do have the ability to move the Canadian dollar, especially if they both come out either negative or both come out positive. They come out mixed. It'll likely be a mixed reaction here from the Canadian dollar. And at this point, we don't have any forecast analyst expectations up here at this point, but check back later in the week. That should be updated. And that does it for our risk events for the week. Happy trading. Take care and goodbye for now.